Welcome, everyone. My name is Yanira Villanueva, and on behalf of FIBA, I would like to welcome you to today's FIBA webinar entitled Managing AML Risk and Trade Compliance Management, a focus on the Americas. We'd like to remind everyone listening to subscribe to our YouTube channel to stay up to date on our latest webinars and all FIBA activities. And you can also follow us on Twitter, LinkedIn, and Facebook at FIBA_bankers. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. You may send in your questions at any time during the presentation, and we will collect these and address them during the Q&A session at the end of today's presentation. And also, we actually have polls in this webinar, so you can have a little bit of an interactive experience as well. And now I'd like to introduce today's speaker. Today we have Henry Bolani. Henry Bolani is currently Global Head of Strategic Affairs for Acuity. He's responsible for driving thought leadership in the industry. In his prior role as Head of Innovation, he helped pioneer new AML sanction screening solutions related to trade finance compliance. He was previously Managing Director with responsibility for managing Acuity's compliance group that includes product management and professional services related to all compliance risk solutions. Acuity is a global provider of payments and compliance solutions with clients in the financial services and corporate sectors, including banks, money service businesses, insurance, ship and manufacturing firms. Henry, the audience is yours.
Thanks, Irina. Appreciate that. Well, good morning, and in some places I expect a good afternoon to you as well. So I certainly appreciate your time, taking some time out of your busy day today. I also appreciate that we've had challenges on the East Coast, especially in Florida and some of those areas. So hopefully everybody on this call had, was able to get through it, and everything's hopefully back to normal. So I appreciate your time. So as Irina was saying, we are talking about AML risks and how to manage those risks in trade compliance management. And so what I'd like to do for today's session is really talk to you a little bit more about what we'll be covering over the next hour or so. Now, just so you're aware, as Irina had mentioned, we've got this questions capability. So feel free to type in questions along the way. I will try and scan it from time to time. But we will have a dedicated Q&A session 15 minutes before this session ends. So a quarter past the hour. Quarter towards the end of the hour, we'll have questions. So I'll leave 15 minutes for discussion around that as well. But also, as Irina was suggesting, we have a Q&A poll type facility. So I will be asking questions. So I do ask for your feedback and input. It's always interesting to get the audience's reactions to various issues out there. It gives me a sense of what the audience is thinking, so I can tailor some of the comments. But also, I think it gives the audience themselves an understanding of what your other members are thinking about in terms of some of the challenges and issues and the questions that we raise. So just some housekeeping there. So let's get on to the agenda itself. So what I'd like to do today is really talk about the importance of trade, and talk about the importance of trade in Latin America and the Caribbean, and in some ways how it affects North America as well. This is an audience that I understand covers the Americas, so it's good to focus on these regions and get an understanding of what that is. I'll also be talking a little bit about the challenges, the increasing challenges of trade compliance. Now, one of the biggest issues I'm sure most of the audience members are aware of is correspondent banking and the de-risking of correspondent banking. I'll get into that a little bit, and also kind of give you a sense of what that means from a trade compliance perspective. What is that? How does that affect trade finance, and some of those types of issues there. I'll also cover a little bit of the examples raised around trade-based money laundering. I'll define what that is. I'll give you a couple of methods and instances of how trade-based money laundering actually occurs, and give you some real-life examples, as well as finally giving you some takeaways of really looking at a trade transaction. What are some of the red flags that you should be really looking at? So what we've done is we've actually compiled some expert information based on various associations and industry regulators and so forth, and pulled together a couple of red flags that you can take away directly as a result of this conversation. So that's kind of the agenda here. So Irina, actually I wanted to get going right away with a poll question. So let me go ahead and describe that, and Irina, I know you'll set it up and kind of switch it over. But what I'd like to do here is get your feedback on trade. where do you see trade going the next 5 years in the Americas? Try to get level set here of that in terms of the opportunities. Do you see it significantly improving? Do you see it somewhat improving? Do you see it somewhat declining? Or do you see it significantly declining? So if you can respond to that question, I would definitely appreciate it. It would be good to see that. Irene, could you put it up on screen?
It's currently up on screen, yes.
Oh, okay, all right. So I can't see it, so I'm not sure what the response is.
Yeah. Right now, we're at 26% significantly improving, 54 somewhat improved.
Yeah, I see it now. Thank you. Yeah, so it looks like it's moving around a little bit, and you know, generally the audience looks at it as somewhat improving. So about 56% somewhat improving. That's great. So it's more of a positive group here in terms of their outlook on where they see trade is growing. Let me share with you. So thank you. Let's go back to the actual slides themselves. So let me share with you from some research that's been conducted out there recently in terms of where we see trade. So you've got the World Bank and the OECD looking at the actual data itself, and what this chart shows is really trade as a percentage of GDP. So in other words, what we're looking at is the percentage increase in trade based on GDP itself. So gross domestic product, and this really looking at the percentage change for both imports and exports globally. And so what you've seen is that while generally since the 1960s, trade has become more important for countries because it reflects a higher percentage of their GDP, only recently, especially when you look at 2010, when you had the global financial crisis, trade became really a much smaller percentage of GDP. It bounced up a little bit again. But you can see that overall, at least 2015 onwards, there's a bit of a decline. So I agree with you in terms of the you know, your feedback. Certainly, when you look at trade, it's somewhat improving. I think there's a realization that we've had challenges in the past, and that you know, we should hopefully go forward. So hopefully, the 2016 data at the end of the year will reflect a little bit more of an uptick. In other words, that trade becomes a greater percentage of global GDP than it is now. But there are obviously various issues and challenges associated with that. And so let's dig down a little bit in terms of what that means and why that's the case. When you look at commodity prices, that's really kind of a big driver in terms of the decline in overall trade, because the revenues derived from the actual trade itself have gone down. You see, for example, the commodity prices here. You've got energy, metals, and agriculture. And certainly these are very significant commodity exports and imports for various you know, countries in both North and South America, Latin America, Caribbean, and so on. So you definitely see that the commodity prices remain soft. That's one factor. There are other challenges to global trade as well when you look at it. There's the notion of rising protectionism. I think we all recently saw the you know, the results from the UK. And certainly there's a lot of rhetoric right now in North America, the United States specifically, and in other parts of the world in terms of rising protectionism. These are challenges certainly to global trade. Certainly, whatever the you know, the justification is, you know, there are merits, there's recognition that there are challenges, but you see a general trend towards rising protectionism, and this certainly impacts trade. One of the potential outcomes, a significant outcome to that level of protectionism, is the Trans-Pacific Partnership. As we all know, the Trans-Pacific Partnership is a group of 12 Pacific Rim countries that are looking to negotiate a free trade agreement in terms of being able to import and export within their respective countries. The challenge, as we all know, in the United States specifically, is that there's still risks of not ratifying the Trans-Pacific Partnership. Both candidates currently have indicated that they are not in favor of the TPP, one more so than the other. But I think there's you know, certainly a possibility that might go through, but I think there's a risk that because of not being able to ratify the TPP, that you've got these challenges towards global trade. Now, when you look at Latin America and the Caribbean specifically, you see quite a lot of challenges here. And so this is actually a chart from the Inter-American Development Bank, and they actually provide some data points in terms of where they see overall growth. When you look at the red box that are highlighted, again, these are various countries within the region. But overall, when you look at the growth rate in 2015, we've seen a negative 15%. In other words, you've seen a decline of the value of exports, in the region. Again, part of it is certainly due to the soft commodity prices, but it's also due to the overall decrease in the volume of trade. And you saw in fact, a declining growth rate of negative 15% there. Overall, in Q1 of 2016, you see a somewhat improvement, but still overall a negative decline. So it doesn't augur well necessarily in terms of some of the challenges there. Why is this important? Why am I focusing on some of these numbers? The reason I'm doing that is because when you look at trade as a percentage of GDP, especially in the Latin American countries, it is fairly significant. Here is a chart from the World Bank. This is data collected from the World Bank and the OECD, looking at trade as a percentage of GDP. In this case, when you look at the smaller countries in Latin America, typically, as you know, smaller countries tend to rely more on trade in terms of being able to boost their economic growth versus larger countries. So you got Honduras, Antigua, Barbuda, St. Lucia, and so forth on the left, showing a fairly significant percentage of trade as a percentage of GDP. And you got some of the larger countries in Latin America, for example, Brazil, Colombia, and Peru, that are as low a percentage. It's still important to them, and you can see that overall the region averages 71% of GDP. So just to be clear, when I look at GDP over here, I use a classical economic term in terms of including goods and services, and this could also include tourism and all the other services generated by the various countries in this particular chart. So what does this mean for the countries themselves? They want open, efficient trade. They want open, efficient processes. They want the ability to grow their trade, because that's such a significant part of their economy as well. Now contrast this with one of the largest countries here in the Americas, the United States. The United States itself is at 28% of GDP overall. And you can see that when you look at these sample set of countries, the USA is in fact the lowest in terms of their percentage of GDP, which in some ways can help to explain some of this anti-trade rhetoric, some of these anti-globalization sentiments and so forth that you're hearing in the current political debate here. And so the issue becomes, what does that mean, right? If you have a country that's not as reliant on trade, certainly when policies are developed, there may be choices that are made, and it could be choices that are at the expense of global trade. And that's partly what's driving some of the discussions today. So let me kind of switch over and just kind of give you the lay of the land here, give you high-level kind of global economics here, so that we understand some of the challenges that we have. Now let's look at the next poll question. I'd be curious to get your feedback here. Now this question really is about compliance. We're focusing a little bit more in terms of what that means for financial institutions in this region. And so what I'd like to hear from you in terms of what you see the cost of compliance looking like. Do you see the cost of compliance increasing over the next 5 years? And it's a fairly simple yes or no response here. A for yes, B for no. And I see the results already coming in. And so not surprisingly, half of you have voted, and half of you already have said that 98% of you agree that the cost of compliance will continue to increase over the next 5 years. That's unfortunately, that's true. I mean, we've seen a lot of regulations. I'll talk a little bit more about that as well. But you can see that a majority of you, in fact, a significant majority of you agree with me that the cost of compliance will, in fact, increase. So thank you for that. So you've got global economic conditions. You've got some of those challenges and issues that are out there in terms of what we see as challenges here. Now let's look at how they affect the trade finance area itself. So you've got global economic issues. Let's kind of focus a little bit more on the trade finance area in terms of the compliance issues. Here are some of the reasons which I think are some reasons why compliance costs are increasing. There's certainly others as well, but let's talk about some of these areas as well. The first one certainly is about screening for terrorist financing and money laundering. In fact, that is probably the key factor as to what's driven the increase in the cost of compliance here. right? In fact, this probably sets the basis for all the other reasons as to the rising cost of compliance here. We all know certainly what happened in the United States in September 11, 2001. That in some ways was a significant catalyst, because at that point in time, what we were not aware of was how these nefarious organizations, these terrorist organizations, these bad actors, how they were using the actual financial system, the global financial system, to move their illicit funds around. So certainly there's awareness of that, but I think the September 11, 2001 activities highlighted the role that financial institutions provided in terms of facilitating some of those movements of funds. So, for example, those terrorists that flew the planes into the World Trade Center, they actually used their local banking networks. They used ATMs. They used wire transfers to move their money around. There's even instances where they use the ATMs to pull money out. So the FBI was able to determine when and where they were able to do that. So there is the reliance on the global financial system to aid some of these money laundering and terrorist financing activities. It still continues. We still see that, and so the regulators around the world are certainly aware of that. And so what they have obviously done is created various regulations. The USA Patriot Act was one of them. But I think the enforcement actions were really kind of a signal to the banking industry, to the financial services industry, that they're quite serious about being able to eradicate these activities. So what's happened consequently is that financial institutions have put in systems, have put in various technologies, processes, tools, and so forth to be able to screen for these types of activities, right? Terrorist financing and money laundering. But what's also happened recently, over the past 10 years as well, is that there's a growing awareness that there needs to be additional screening for sanctioned goods and vessels. In other words, it's not only the actual movement of the money from point A to point B through a wire transfer, it's also what's actually being shipped. What are there vessels, for example, that are being used in terms of transporting illicit goods, or even screening for dual-use goods? I'll talk about dual-use goods in a little bit more detail later. But the idea here is that you may have goods that can be used both for civilian and military purposes. The challenge is that when you combine potential chemicals, for example, they can create some kind of explosive device using potassium nitrate, for example, which is a typical chemical for fertilizers, can, combined with certain other chemicals, can be used as an explosive device, and that's been commonly used in some of these IEDs that kill troops in the Middle East, for example, and in many other places as well. But the idea is that when you look at dual-use goods themselves, it's a challenge in terms of being able to identify, well, are those goods can potentially be used for explosive devices, or are those goods potentially, when combined in a certain way, can be used for something that other than its intended purpose? So, for example, ball bearings being used in bicycles that we know, and many different uses of it, can also be applied, for example, in the use of centrifuges in terms of enriching uranium. So ball bearings itself could be considered dual-use good, depending on the dimension, the weight, the mass, and so forth. And so what financial institutions that deal with trade finance now have to deal with is that they need to also identify whether those goods themselves are sanctioned, whether those vessels are sanctioned, as well as understanding whether those goods themselves are sanctioned. No doubt that would cause a lot of increase in effort in terms of processes and so forth. So those are some areas. These are other areas that you can look at in terms of compliance costs as well. You're looking at enhanced due diligence. You're looking at ultimate beneficial owners, the need to be able to screen for those. The Panama Papers, for example, certainly highlighted the challenges of offshore companies. And not only the use of offshore companies, because as we all know, offshore companies in and of themselves are legal. There's nothing wrong with having an offshore company. The challenge is, what do you do with it, right? And the problem as well is, how do you identify the ultimate beneficial owners? Because part of this process includes understanding where the beneficiary is, who the beneficiary is, why are they potentially moving some of this money around? Is it for tax avoidance purposes? Is it for investing in in some real estate in Miami, or whatever the case may be? So the need to be able to screen ultimate beneficial owners becomes more and more of an issue here, especially since the Panama Papers. There are calls from various government agencies, from various politicians around the world, saying that we need to do more. We need to know who the ultimate beneficial owners are. The challenge is being able to determine that. It takes a lot of effort, for example, especially when you look at these offshore companies, where one of the roles of an offshore company is to kind of anonymize who the owners are for various reasons, again, good and bad. But the problem is the process by which it's causing the effort that needs to be identified, though. So all this actually leads up to de-risking in terms of correspondent banking. Correspondent banking itself, here the issue where is you may have a bank, for example, in North America, and Canada, North America, or any of the Western countries, providing financing in various aspects, either through trade finance or through various loans, investments, and so forth, into other regions that may be at higher risk. They may have determined that, for example, a country in East Africa may be too risky for them to be able to work with, because they are not able to define who the ultimate beneficial owner for that particular transaction may be. And so as a result, they go into wholesale de-risking. This is a significant topic. We'll get into that in a little bit in detail as well. But I just want to kind of give you some of the elements here that are actually increasing compliance costs, something that we need to consider as well. So here at Acuity, what we did was we actually looked at the correspondent banking relationships. We looked at the number of correspondent banks overall, and we looked at the actual decline in the total correspondent banking relationships. And this is actually a fairly telling chart, right? Because you look at the number of institutions, right? These are financial institutions. When you look at 2013 to 2016, you can certainly see an increase in the number of financial institutions there. That's a blue line itself. But at the same time, you see that there's a decline in the total correspondent banking relationships around the world. In fact, there's a 39% drop in the number of correspondent banking relationships between 2013 and 2016. That's significant. And a lot of that is due to the risks that we just talked about in terms of the challenges of being able to identify the beneficial owner, the risks associated with that, the margins as a result of not being able to be as profitable in those correspondent banking services, have led a lot of these North America, Western banks, global banks to actually withdraw these correspondent banking services. It's a significant issue, and unfortunately the data here, as we demonstrate, proves that point. It has unintended consequences, by the way, when you look at de-risking. Here's a couple of charts from the IMF that show the withdrawal of correspondent banking relationships. Just last week, for example, the IMF held a high-level workshop discussion with central bank governors around the world. And Christine Lagarde, the managing director of IMF, highlighted the challenges that emerging economies, that developing economies face as a result of de-risking. And here's some of the feedback, right? For example, when you look at the chart on the left, banking authorities were asked in terms of what the impact of de-risking, where the areas of impact have been in terms of de-risking, in terms of some of the financial solutions and financial transactions. Trade finance is up there. I mean, obviously, wire transfers is more significantly impacted, but trade finance is certainly up there. When you look specifically at Latin America, for example, from that perspective, you see that trade finance is also an issue. Remittances certainly is a big issue, and what I mean by remittances here is that you may have workers in countries where they earn money, where they do not live normally, and those funds need to be transmitted back to their home countries to feed their families and so forth. There are many countries for example, in the Caribbean, countries in East Africa, in Southern Africa, East Asia, and so forth, that rely on these remittances coming from their citizens abroad. And so it becomes a real issue. Again, trade finance is up there. So I found that quite surprising, but it's not unusual if you look at it, because ultimately, if you have global banks de-risking or withdrawing from those areas, the ability to finance those trades becomes more challenging. And that's the issue here. If you look here at the actual countries that have been affected by this de-risking, here's some of them. Again, what we did was we actually contacted our clients in those regions, in those countries, and asked them specifically, have there been 5 or more banks for example, that have actually been affected by these correspondent banking relationship withdrawal. And there's a lot. I mean, there's other countries in Latin America. I didn't highlight it for this discussion, but you can see that there are quite a few countries in red where they have been affected by the withdrawal of correspondent banking relationships. And here's some of the reasons that are given, right? There is a presence of an offshore sector. So now, again, the impact of the Panama Papers, that because of these offshore sectors, that they are not being able to determine who they are, what the ultimate beneficial owner is, and so forth, it becomes a challenge. There's concern over the legal frameworks. Are the justice systems, are the courts, for example, being able to effectively go after money launderers or go after these bad actors? There's that concern. There's also high-risk customers. Certainly, if you do not know who you're dealing with, chances are you're going to treat them with high risk. Higher risk means that you've got to spend more time doing your due diligence to be able to determine the risk level of that customer, which therefore means that there's a lack of profitability from that perspective. And certainly, you know, you've got the U.S. regulators primarily highlighting the issues around sanctions, highlighting the issues around money laundering, terrorist financing, and so on. And so North American banks typically feel that the costs overall of maintaining these correspondent banking relationships are not worth maintaining those, and so they withdraw from that. So here's some reasons. Certainly, you know, I've had the opportunity of talking to the central bank governors last week at the IMF in those discussions, and what they came back with was ultimately their banks themselves sometimes are not even given a reason as to why these relationships have been withdrawn. And some of them have even said that it's just business reasons, nothing more. And it becomes really frustrating. And sometimes they don't even get enough notice in terms of that withdrawal of the correspondent banking relationship. So the remittances and the trade finance and so forth, they need to seek alternative ways, and it becomes an issue as well. Okay, so let's kind of switch it back to you. That's some of the research that we've found when we asked some of our banking customers as to the impact of correspondent banking relationships. But I'd love to hear from you. Have you or your banks, your bank itself, been affected by these withdrawal from North American correspondent banks? Easy, it's a yes or no question. So would like to hear your responses. So we'll see how that continues. You got about 25% responding, and so it's interesting. When we hear the challenges that a lot of these banks face, and these are banks mostly outside the North American region, right? So if you're a bank outside the North American region, there's a higher likelihood that you might have been affected by this correspondent banking relationship here. But okay, let's see this. Okay, so we've got about half of the audience voting. And interestingly enough, 59% say no. Okay, that's I guess that's good. Maybe these banks recognize that this has been a challenge, because one of the things I'll be talking about later is some of the ways of actually being able to assess or minimize some of those risks. And it looks like those banks that have responded, or those folks that have responded no, have actually recognized that there's a challenge. So that's great. I think I'm really encouraged by that response, so that we've actually been starting to address it. I think if I were to have this discussion, probably, let's say, in parts of Africa and parts of Asia, I probably will get the inverse of that. So yeah, it's obviously situational here. So I thank you for that. So let's move on to the next slide here. And as I mentioned earlier, what's driving overall the correspondent banking relationships, the withdrawal, is really the penalties. When we speak to our large global banks themselves, you know, they've certainly put in a lot of services, institutions, systems, processes, and so forth, and really significantly ramped up their compliance departments. So while we hear a lot of jokes, for example, in terms of the banking industry, you know, kind of facing challenges and so on, it's interesting to hear that when you look at compliance, that's a growing sector in the financial industry, in the banking industry. And it's not without reason, right? You see these penalties. Obviously, 2014 was in some ways a highlight of these penalties because of one significant penalty on a French bank. And so you have that. 2016, we haven't seen a lot, but overall, when you look at the number of fines since 2009, you're looking at over $16 billion, and that's a pretty hefty fee just for this particular area. There's obviously fines in many different non-compliance areas, right? So the mortgage scandal and some of those types of issues also have added to that. This is not that. This is just purely looking at AML and sanction violations. So I mentioned earlier, de-risking is a challenge. It affects economic growth. And I found this particular chart, which is, I think, quite true. Right? This is actually from a guest worker that lives in Somalia. And so Somalia has had a real challenge, especially with the de-risking, because as of right now, Somalia has very little to almost no correspondent banking services. So remittances cannot be sent back. And so it becomes a real issue there. When you look at trade, as I mentioned, because of the fact that you don't have financing, you've got impacts on economic growth as well. Part of the issue here is when you look at trade finance, why it cannot be financed, what the challenges are, the risks associated with it. Part of it is based on trade-based money laundering. This is one of the major factors. There are many other factors too, of course, when you look at overall de-risking. But trade-based money laundering is one of those factors that actually leads to de-risking. So I've looked around in terms of different parts of the world to kind of just give you a sense of some of the challenges that are related to trade-based money laundering. So the United Nations, for example, looks at countries that have been impacted and they lose a lot of their commodity export revenue due to misinvoicing. That's one of the instruments of trade-based money laundering. You've got the US, for example, talking about funnel accounts and trade-based money laundering specifically. This is a couple of years ago. In the UK, for example, about several years ago, the Financial Conduct Authority came up with a thematic review to kind of talk through some of those challenges of financial crime risk, especially in trade finance. Hong Kong, same thing. Hong Kong banks have been warned over trade-based money laundering. And the Department of Treasury, in terms of the National Money Laundering Risk Assessment in 2015, also highlighted trade-based money laundering as a concern for global economic growth. How does trade-based money laundering actually occur? It's pretty simple, honestly. Let's say you have a exporter in Mexico and you have an importer in the U.S. This may and you have, for example, this money that needs to move from the U.S. to Mexico. This money could be from drugs. So you can have a Mexican cartel, for example, and El Chapo, for example, that sold all these drugs for example, in the streets of Chicago. They got all this U.S. dollars. They need to move back to Mexico. How do they do that? They do that through trade. And the process essentially is to over-invoice. So you have an exporter and an importer. So you have a company that's set up in Mexico that exports goods, and this importer in the U.S. The goods, are invoiced at 1 million, for example. The value of the goods at 1 million. However, the goods themselves are invoiced at 10 million. In other words, even though the cost of a pen, for example, could be $1, what's on the invoice is $10. And so what happens is that when the goods are moved, when the goods are exported to the importer there, the importer actually ends up paying for an invoice price of $10 million. And so what happens here is that you've actually over-invoiced. And as a result, you've effectively moved that money from the U.S. from the U.S. to Mexico because of the greater value of the supposed value of those invoices, of those goods. Other examples, black market peso exchange, classic TBML scheme as well. So, for example, if I am a businessman in Colombia and I need to be able to finance some investments in the U.S., or I need to, for example, pay for my college, my daughter's tuition, if she's attending university in the U.S. Now, those tuition fees are expensive these days. I need to get the money over there. How do I do that, right? I need to be able to send that money. But however, you also have these, these drug lords in Colombia, for example, that need local pesos. There is a peso broker that will go ahead and actually do that swap and be able to provide more favorable rates to that businessman, to that Colombian businessman, rather than being able to go on the regular foreign exchange markets. And so through the black market peso exchange, you actually have a swap of pesos for dollars. The dollars still sit in the U.S. In other words, they don't actually come back. That drug money doesn't actually come back, but it is credited and used for various purchases, investments, paying off tuition and so forth by these various businessmen that need those US dollars. It's been a scheme for quite some time, and it continues to be a significant mechanism by which these dollars are transferred. So I wanted to kind of get a little bit of your feedback on some of these trade finance transactions, and look at what you see as the main reason for rejecting trade finance transactions. So if you can open up the poll again, here's the question. What was the main reason for rejecting a trade finance transaction in the past 12 months? So was it AML sanctions? Is that why you rejected that? Or was it that it was simply not profitable? You looked at the margins and you looked at what was doing it. May have been that the letter of credit, for example, was simply a small amount, or that you had to do a lot of customer due diligence, or you felt that the risk profile was much, not acceptable, so therefore you rejected that, or the actual value of the goods themselves did not seem right. So let's see what those. Let's take a look at what the responses are. Irina, is the poll open there for that one?
Yep, I have the results up on the screen.
Okay. Yeah, I'm just having a slight technical issue trying to get the results of that. Hang on. Hopefully I get the response there. Oh, there we go. Okay. All right. So the audience has voted, and the audience has said that 37% are due to AML sanctions issues. But what's interesting is that 41% said that it was due to the customer risk profile. So a majority of, well, it's close really. So it's the customer risk profile and AML sanctions are the main reasons for rejecting a trade finance transaction. So that's interesting, certainly, because I think at the end of the day, that's important, certainly, because you need to be able to do your due diligence, and the regulations are certainly a driver there. But what's interesting as well is that only 6% said the value of the goods did not seem right. Now, there are a couple of reasons behind this. Number one is because how the heck do you even value those goods themselves? And we'll go through some examples of what those are. And number two, typically when you look at financing trade, banks, their focus really is on making sure the documentation is legit. In other words, do we have the right letter of credit? Are the invoices, purchases orders, all of them aligned? The actual value of the goods are not as significant. And a couple of reasons why, right? Number one, the UCP 600, this is some of the guidelines that are used for international trade or financing of international trade. But more importantly, I think the value of the goods themselves is really, really hard to determine. Let me walk you some examples of that. You have, for example, metal tweezers. These are real examples, by the way. I'm looking at over and under invoicing from and to the U.S. So I went out and looked at, got some data points to kind of illustrate some of the points. When you look at metal tweezers from Japan to the U.S., so you're importing metal tweezers from Japan to the U.S. How much would a metal tweezer be? When you look at wholesale prices, maybe $1, maybe $2. I don't know, maybe even $5. I don't know. When I go to the local convenience store, right? I find when I buy a pair of tweezers, maybe I buy $10 retail. Here's what the invoice price was: $4,896 per unit. I was shocked when I looked at the actual invoice itself. This is real, by the way. This is not any kind of made-up data. This is actually data from invoices itself. So you're $4,896 a unit. Another example: camshafts from Saudi Arabia to the USA. Camshafts are these engine parts that are used to help move the fuel from the tank to the engine itself. I'm not a car expert, but I do know that these are important components. When you look at camshafts imported from Saudi Arabia to the USA, so how much would they be worth? Maybe a good camshaft, about $400, $500, give or take. It was $15,200 a unit on the invoice. Another example: plastic buckets from Czech Republic to the USA. How much would they be worth? Even the best plastic bucket, the most high quality plastic bucket, it's $10 maybe. I don't know. This is what it was on the invoice: $972. Let me keep going here. When you look at exports, now I'm going the other way, right? These are exports of radial truck drivers from the USA to the UK. So it's going from the USA to the UK. Radial truck tires. These are, these typically truck tires are fairly large. I would suspect maybe about $100, $200, give or take. This was also an invoice, $11.74 a unit. Another example: toilet bowls from the USA to Hong Kong. How much would they be, right? on the invoice is $1.75 a unit. There's no way a toilet bowl would cost and would be so low, unless it's a toy. But in this case, this is a real toilet bowl. Prefabricated buildings. I love this one. These are prefabricated buildings. Like these are types of ready homes. These are used, for example, you see them in trailer parks. You see them in as part of containers and so forth that are used for either residential or for business purposes, commercial purposes. The invoice showed $1.20 per unit. It did. And so it's very surprising to see that. So I said these are all various examples of that. These are extreme. Now certainly any trade finance professional, when they look at an invoice, any reasonable person when they look at an invoice will recognize that this is an issue. But when it becomes a challenge in terms of being able to determine how close it is to the actual price, it becomes more difficult. So I'm not surprised by the poll result earlier when they said that when you look at the value of the goods, that's not as significant. Because number one, it's not necessarily necessary when you look at UCP 600. Number two, it's really, really hard to determine what those invoice prices should actually be. So that's kind of just a walkthrough of some of those issues. I have another poll question for you. I want to kind of get a sense from you in terms of when you actually do the screen itself, what elements do you look at in terms of trade transaction? So it should be open now, and so here's a question. What elements of trade transaction should be screened for AML sanctions and risks? You got things like recipient, beneficiary, vessel, goods, or all of the above. So yeah, I'm not surprised that most of the audience have come back with all of the above, and that should be the right thing, right? The challenge becomes how much emphasis, what do you place, how much time, effort, costs do you place on being able to identify all of these, right? Recipient, beneficiary, you use various screening lists out there. Vessel, same thing. Goods, it becomes a little bit more of a challenge, both in terms of identifying them as well as the value. But the audience is correct. We should be looking at all of the above. So in the last few minutes, I want to kind of give you a discussion about some of the best practices that you should be looking at in terms of how you actually can at least alleviate some of these trade-based money laundering challenges. We looked at various reports. So see, these are some of these reports around there. And we kind of compiled from all these regulators, experts, associations, and so on, and tried to distill it down to what we thought some of the key red flags are when you look at identifying potentially suspicious transactions. The first one is really looking at the types of transactions. If you have an agricultural company, for example, that starts dealing with paper products, it may not make any economic sense. That should be a red flag. So, for example, you an export, as I said, the exporter here that typically exports wheat or corn or something like along those lines, and all of a sudden they start to deal with paper products or something that's not traditionally aligned with their industry. That should be a red flag. It does not mean that this is you should reject the transaction. Not at all. All it means is that you should be doing more due diligence around it. Other areas, when you look at businesses that conduct business in high risk jurisdictions, that are risk for terrorist money laundering and so forth, that should be a red flag. The challenge here is it seems inherently obvious. Of course we will do that if it's high risk. The problem is identifying what those high risk countries are. High risk countries change over time. So for example, just recently, about 3-4 weeks ago, Myanmar or Burma, whichever one you call it, is no longer necessarily considered a high risk country because sanctions have been lifted. Every financial institution can now deal with Myanmar, Burma. This is from a U.S. OFAC perspective. However, you've got other countries that potentially, due to whatever reasons they are, there's additional risks associated with that. Then they become high risk. So I think we need to be able to kind of make sure that we recognize that there's risks. The problem is being able to maintain the list over time that helps identify truly what that risk is. You also have transactions that appear to use shell companies, front companies, that hide these true parties involved. As I mentioned earlier, the ultimate beneficial owner challenge as a result of the Panama Papers has become a real issue. This is actually really, really important right now, I think, in terms of the financial industry, because it's a real challenge identifying who they are in the first place. And so it takes a lot of effort, cost, and so forth. It should be a red flag, however. It should not be something that says, oh, just because it's a company that we haven't heard of, or that we think overall the transaction's okay, then we should go. We should let it through. We should be looking at every company. We should be able to at least cross-reference it, do some of the due diligence to identify if it's a shelf of front company, and then move forward from there. Related to the high-risk country issue, looking at non-cooperative jurisdictions. So the Financial Action Task Force, for example, came up with a list of non-cooperative jurisdictions. Certainly, that's an easy one, right? Go up to FATF, it's easy to download. In fact, just type in non-cooperative jurisdictions and Google, you'll go to FATF and you'll find that list. And use that as a benchmark for you. Again, this is all about risk assessment, right? It's about whether you want to deal with some of those potentially sanctioned countries or non-cooperative jurisdictions. So, for example, a bank in the United States, for example, or a corporation in the U.S., when you deal with Iran, you have to kind of move very carefully. Just only recently, in fact, I think OFAC came up with additional FAQs in terms of treatment of non-U.S. entities with Iran, in terms of dealing with Iran. For U.S. entities, however, Iran is still a no-go, especially for those countries that, especially for those entities that are part of the Iranian government or part of the Iranian Revolutionary Guard Council. So there's a list of sanctioned entities in Iran. So those are primary sanctions are still in place for U.S. citizens. So it's important to be able to at least identify what those non-cooperative jurisdictions are and be able to then make a decision accordingly. The other issue is dual-use goods. As I mentioned earlier, these are goods that can be used for civilian or military or bad purposes. I mentioned earlier dual-use ball bearings, for example. But it's important to think of dual-use goods as being a wide range of goods that are really designed for commercial applications, but as mentioned, can have military applications or can be used for weapons of mass destruction. Syria, for example, just recently chemical weapons were used, and some of the base chemicals that were used to manufacture those weapons of mass destruction were based on imports of chemicals from outside the country. And that was unfortunate, but it happens. What we've done, at least in Acuity, we recognize that this is an issue. And so literally what we've done is we've looked at, we've compiled what we think are appropriate dual-use goods. This is from the EU dual-use goods list, and provided that as a database. And so we have kind of a little fun game. So, after this this seminar, you certainly, go to our website. We can make this deck, give you this deck as well, but go to that link below and you can actually play that game and determine what in fact is a dual-use good. It's interesting. It's a bit challenging. I won't give you the answers now, but it's kind of fun to go through those questions and kind of determine for yourself. The answer is surprising. What you think is maybe obvious dual-use goods are in fact not, and what you think that are dual-use goods in fact are. So as a kind of fun game. So I wanted to kind of wrap it up. We've got about 10 minutes left here and kind of open it back to the audience. But I wanted to kind of at least conclude and kind of give you some main points I was talking through here. We know that trade is important to many Latin American countries, right? And it impacts their economic growth. There are threats to trade finance. Correspondent bank de-risking is certainly one major threat in terms of liquidity. The other threat certainly is trade-based money laundering and the awareness by regulators that this becomes a greater issue, and the mechanisms by which trade-based money laundering occurs. The third bullet here really is that we as financial institutions need to make sure they've got the right processes, because ultimately you can identify what the risk of that transaction is, then you can price that risk accordingly. And so then you can make a determination as to whether you want to finance that particular trade transaction or accept a particular letter of credit or whatever the other financial transaction is. But I think more to the point as well, we here at Acuity recognize that this is an issue. And so you actually develop tools, screening engines, identification of potential sanction and dual-use goods, both goods themselves, vessels, ships, airplanes, ports, and so on and so forth to help you identify all of that. So I'd like to throw it out in the last 10 minutes here to questions and try and get your thoughts, any comments that I can help answer for you, anything that you'd like to talk through would be good. I just also, as we're waiting as well, I also wanted to highlight that if you are looking for a copy of the deck itself, happy to share that with you. There was a lot of data in the earlier part of the presentation, which I thought useful, and perhaps you might find useful as well. So feel free to reach out to us. You've got Marie Renoir, who's in our marketing group. Her email is here. We'll leave it up here for the next 5 minutes or so, and you know, feel free to send out a email to her. Happy to schedule a demo as well if you have any questions.
Thank you so much. Yes, thank you for a wonderful and informative presentation. We've been getting excellent presentation comments and feedbacks on the question box. Just a quick reminder to our audience that you can continue to submit your questions into the question box in your GoToWebinar control panel. So let's get started with the first question. Henry, yes. I understand from your presentation that screening of goods is becoming increasingly more important from a regulatory perspective. You mentioned that the USA is not a big trading partner. Do the U.S. regulators also see this as important as other regulators around the world?
Yeah, no, it's a good question. I think, you know, in my early, I think my first or second slide, I showed you the percentage of trade of the USA compared to the rest of the world, especially Latin America. Not high, right? It was 29%, I mean, compared to the average of Latin America, so I think about 72%. So that kind of, in some ways, you know, drives some of these discussions. So do regulators see that as an issue? Absolutely, right? I don't think necessarily is the percentage of trade from a regulatory standpoint, right? So from a business standpoint, it's different. From a regulatory standpoint, because the main concern of U.S. regulators is terrorist financing, money laundering, right? Go back to 2001, as I mentioned, you had these you know, various terrorists using the financial system as conduits to be able to, you know, pay for those flight lessons that they took in somewhere in Florida. They needed that money. That money was moved through the banking system. So for, I think, regulators, their concern really is about the actual movement of money through the banking system. So you got you know, terrorist financing, money laundering that are still concerned. So the focus, I think, is shifting, because I think more U.S. regulators are recognizing that trade finance, it becomes an instrument. They recognize that you could do it traditionally. You know, those black market peso exchange is one of them that has been around for quite some time. It's obviously challenging and difficult to identify because it's, you know, it's done typically outside U.S. borders. But trade-based money laundering and misinvoicing, you know, those types of areas are now becoming more and more of a challenge. I mentioned earlier that when you look in the Far East, for example, Hong Kong and Singapore, they've actually advised their banks, the various associations, even the regulators, have come up with guidance for the financial institutions, financial service institutions, to actually ensure that they're actually doing some of these screening of these sanctioned goods, dual-use goods, and so forth, identifying potential money laundering issues and so forth. The UK certainly has done that. And what I know is that regulators do talk to each other around the world. I mean, they do share best practices with each other. They do cooperate. And so, you know, there is a recognition by regulators here in the United States that this is becoming more and more of an issue. So I think U.S.-based banks are certainly, you know, starting to, you know, pay more attention in this area as well. That's a good question. Thank you. Other questions?
Henry. All right, we have a lot of questions coming in from the audience.
Okay, I'll try my best.
Let's get to another one. Okay, we have here from Albert Da Silva. Albert says, short of a physical inspection, which is costly and cumbersome, how do you suggest assessing the accuracy of the description of goods being shipped in order to assess possible TBML?
Yeah, that's a great question. Yeah, absolutely. Yeah, that's a great question, because I hear that all the time. I mean, it's like, what do you mean? I have to go to every single bonded warehouse and check every single shipment? That's crazy. I agree with you. That is crazy. That's because it's too expensive. The actual cost of that transaction, the overhead cost becomes unfeasible, right? The challenge for trade finance, especially these days, is that the margins on a transaction, on opening up, for example, a letter of credit for a new customer or an existing customer, is fairly low, right? I mean, there's I've seen where it could be like, irrespective of the value of the transaction, $100, for example, right? Or it could be less than 0.5% of the value of the actual transaction. Also depends on the services, level of financing, and so forth. But the point is that the margins are low in trade finance. The margins are low. Another reason why the margins are low is because trade finance itself, when you look at when you compare it to some of the other financial products that banks offer, is relatively less risky, right? It's a fixed time frame. There is, maybe a trade would complete maybe 3 months, 4 months tops. When you compare it to kind of project financing, where the period can be long, the amounts can be large, or that there's no underlying asset backing up that particular, a transaction. Versus trade, you always have the goods there. I mean, you can always underwrite it using those goods themselves. So it all boils down to low margins. And so it becomes an issue in terms of being able to check every physical good. Couple of suggestions, I think, here. Number one, do an audit. I think like do every 10th transaction, as an example. Again, you determine what that should be. You cannot do every single transaction, I agree with you, but I think you can at least do a sampling of those. Do a representative enough sampling where you're comfortable that the results actually do demonstrate that you have, you know what those goods are. As you all remember, I think about 3 years ago in Eastern China, in Shanghai, there was this Qingdao port scandal. And here's where you had these bonded warehouses. And you had these multiple representations of the same goods being used to finance those trades. I think these were metals, some type of commodities. And the banks, continue to finance those trades because they saw different invoices and assumed that they were different goods. They never actually went to necessarily physically inspect those warehouses, and it became a real issue there. So I think it's a matter of not doing all of them; it's just doing a sample of it. You decide what those risk levels are, just based on what you know of your customer. Because I think if you have done the upfront work, if you know who your customers are, if you've done the appropriate due diligence, there's a less of a likelihood that they'll be doing something bad, right? Because ultimately you can identify what the patterns of those transactions are, and then be able to determine the risk level for that, and then you can then decide how frequent you should go and look at those goods themselves. But you should at least look at them.
Awesome. Thank you, Henry. I think we have time for one more question, and I'm not sure if you're able to see the questions coming in, Henry. Is there any specific question that you want to address before we end today's webinar?
Yeah, actually, no, I cannot see the question, so I'm really doing this on the fly here. So I'll,
okay, all right. So let's go. Okay, how about this one from Anil? What kind of compliance oversight is needed for non-customer, non-key parties associated with the trade finance transaction?
Sorry, could you repeat that question?
Yes, of course. What kind of compliance oversight is needed for non-customer, non-key parties associated with the trade finance transaction?
Right. So if I understand this question, I think what you're looking at is that the customer's customer, right? So you have, say, a trade transaction. You have an importer and an exporter. The question then becomes, is there another underlying customer that's driving those transactions? It's a tough one. I think it's a good question because you're asking what type of compliance should be conducted. In my mind, I think it's know your customer's customer type of due diligence here. I think it's important to recognize that when you look at the regulatory framework, when you look at the underlying requirements, you don't necessarily have to be doing due diligence on your customer's customer. As long as you've identified for your customer itself, you've done the appropriate enhanced due diligence or regular due diligence to determine their risk level, right? So because it becomes really difficult to do your customer's customer. But I think if you can determine what that risk profile is, if you have a new customer, for example, a new exporter and importer that you bring that's looking to finance that particular trade transaction, I would strongly suggest that you talk to those, you talk to those customers, and they should be used to it. By the way, they should recognize that you, as a bank looking to underwrite those trade transactions, wants to understand, who those underlying transactions are, and so doing the interviews is important. I think it's as long as you can demonstrate back to regulators that you have a due process in place. I think you'll find that regulators tend to be saying, okay, you recognize what the processes are. You've made every attempt to ensure that you've been able to identify the potential risks. You made every attempt to identify the ultimate beneficial owners, and we'll probably, I don't know whatever the regulators may end up coming up with, right, depending on the actual transaction itself, whether it's egregious or not. But you made the attempt to be able to identify whether there is the underlying, so you understand the nature of the underlying source of transaction, and you should be good there. But as a financial institution, or even a non-financial institution in this case, are you complying with the appropriate regulations in your framework? For example, in the U.S., you've got the USA Patriot Act. The USA Patriot Act actually applies to all U.S. persons. OFAC, for example, when it looks at some of these sanctions, primary embargoes, secondary embargoes. For U.S. persons, Iran is still considered a primary embargo. And so therefore, you need to ensure that you're doing your due diligence. Again, it doesn't matter whether you're a corporation or not. So, or excuse me, whether you're a bank or not, it equally applies. So I think it's a matter of looking at the regulatory framework in each country. I know we have a lot of countries represented here, and understanding the level of due diligence standards for financial institutions versus non-financial institutions. Only then can you make a determination of what you think the level of screening or risk due diligence you have to do in that area. Okay, I know I've gone past my my time here, so thank you very much. And
yes, Henry, thank you so much for a wonderful and informative presentation and webinar. We will be sending a follow-up email to all the participants once the today's recording has been edited. If there's an urgency and you would like the presentation sooner, Henry and Marie have kindly provided their information, which is up on the screen right now, and you can go ahead and reach out to them, as well as the people that had questions that we were unable to get to. You can also contact them directly. On behalf of FIBA and Acuity, we would like to thank both you, Henry, and everyone that participated in this webinar.
great. Have a good day, everyone.
Thank you.